Hey everyone, and welcome back to the channel. Today we're going to list common investment mistakes you should avoid. Let's get right into it. Nobody's perfect. We will all have our ups and downs, especially when it comes to investing. The good news is that most of these errors can be avoided simply by being aware. We will take a look at the most common mistakes and identify ways in which you may be able to stop the habits or even turn them to your advantage. Number 1. Not investing. The most common mistake that a beginner investor makes on their investing journey is not investing. Retirement is costly, and most of us will not be able to save enough without a lot of help from the stock market. Consider saving $250 per month from the age of 25 to the age of 65. If you keep the money in a bank account that does not earn interest, you will only have $120,000 when you retire. Unfortunately, that isn't going to last long. Consider investing that money in the stock market and allowing it to compound, which means you earned interest on your interest. According to the Securities and Exchange Commission, the stock market has had an average annual return of about 10%. With that, your $250 monthly contribution would result in more than $1.4 million when you retire. The same amount of money contributed over your lifetime would be significantly greater if invested in the stock market rather than a non-interest-bearing account. Number 2. Buying shares in a business you don't understand. Another mistake is when investors flock to the latest hot industry but know very little about the company or industry. You risk losing your hard-earned money if you don't conduct adequate research, especially if you don't know the company's financial viability. When you research and understand a company and its industry, you may have a natural advantage over most other investors. Number 3. Putting all your eggs in one basket. When you put all your eggs in one basket, a single negative event can devastate your entire portfolio and, as a result, your financial future. Diversifying your portfolio reduces risk by ensuring that if one of your investments underperforms, it does not necessarily have an impact on your entire portfolio. You can diversify across asset classes by investing a portion of your portfolio in stocks, bonds, and real estate. If the stock market crashes, for example, the bond market may perform well, reducing your equity losses. Investing in multiple companies within the same industry is another way to diversify. You can also buy several sector funds, each of which focuses on a different industry, such as technology or finance. Number 4. Expecting too much from the stock. Another common investing blunder is expecting too much from a stock, which is especially true when purchasing penny stocks. Low-cost stocks may appear to be lottery tickets, with a $500 or $2,000 investment potentially turning into a small fortune. However, penny stocks carry high risk of loss, and investors who expect a small, underperforming company to outperform its peers may be disappointed. It is critical to have a realistic expectation of the performance of the company's shares. Number 5. Investing money you can't afford to lose. When you invest money that you cannot afford to lose, your emotions and stress levels rise, leading to poor investment decisions. Consider your risk tolerance when evaluating stocks, which is your willingness to lose some or all of your initial investment in exchange for higher returns. When determining your risk tolerance, consider the securities or asset classes with which you are most comfortable, such as growth stocks versus bonds. Don't put money at risk, such as your rent or emergency savings, into investments. By investing money that you can afford to lose, you will make much better investment decisions. Number 6. Being influenced by impatience. Another common investing blunder is a lack of patience. Stocks may not produce the desired returns right away if you are investing for the long term. If a company's management team announces a new strategy, it may take months or years for that strategy to be implemented. Too often, investors will purchase stock and then expect the stock to act in their best interests. Number 7. Getting stock information from the wrong sources. Another common and costly investing mistake is getting stock tips or information from the wrong sources. There is no shortage of so-called experts willing to offer their views while presenting them as educated and infallibly correct. Even stock analysts who work for investment firms make mistakes despite having a thorough understanding of the company and the industry they cover. In other words, even if they are qualified to express an opinion, they can be incorrect. For general investment advice or guidance, government-backed sources and non-profit organizations are a good place to start. You could also seek the advice of a financial advisor to help you through the process. Number 8. Following the crowd. Another investing mistake is to follow the crowd or the herd, which often does not involve research and instead mirrors what other investors are doing. Many people learn about an investment only after it has performed well. When the price of a stock doubles or triples, the mainstream media usually covers it as a hot take. Unfortunately, by the time the media becomes involved, the stock has usually reached its peak. At that point, the investment is almost certainly overpriced. Nonetheless, stock coverage on television, newspapers, the internet, and radio can push stocks into excessively overlauded territory. That's it for today. If you guys enjoyed the video, make sure to hit that like button. Don't forget to subscribe and turn on that notification bell so you never miss out on any future content we'll produce for you guys. We're signing off now, but we'll be sure to catch you all in the next one.